Most people spend their entire lives working for money. Very few people learn how to make money work for them. This single difference quietly separates financial stress from financial freedom. Stock investing is often misunderstood. Some see it as risky. Some see it as complicated. Some believe it is only for experts. The truth is simpler. Investing is the act of owning growth and giving time a chance to work. Every great investor started as a beginner. They did not begin with perfect knowledge. They began with curiosity and patience. Warren Buffett once said, "The best investment you can make is in yourself." This journey is not about predicting markets. It is about understanding businesses, controlling emotions, and building habits that compound for years. The goal is not quick success. The goal is lasting progress. Before learning strategies, you must understand one simple idea. When you invest in stocks, you are not buying numbers on a screen. You are buying pieces of real companies that create products, solve problems, and generate value. This idea leads directly to the first step of your journey. To invest with confidence, you must clearly understand what stocks actually are. And that is where we begin. Chapter 1. Understanding what stocks are. A stock represents ownership in a business. When you buy a stock, you are buying a small part of a real company. That company may create products, offer services, employ people, and earn profits. Your role as an investor is to participate in that growth over time. This idea changes the way you see the market. Prices stop being noise, and businesses become the focus. Great investors do not ask which stock will move tomorrow. They ask which business will still grow years from now. Companies issue stocks to raise money. This money helps them expand, build new products, enter new markets, and improve operations. In return, investors receive ownership and the possibility of future rewards. These rewards may come from rising stock prices or from profits shared with shareholders. Peter Lynch encouraged investors to observe everyday life. He believed many great investment ideas are visible in the products people use daily. When you notice strong businesses around you, you begin to understand investing in a practical way. Ownership also means responsibility. An investor should learn how a business earns money, what risks it faces, and whether it has long-term potential. You do not need complex analysis at the beginning. You need curiosity and the habit of asking simple questions. Why do customers choose this company? Does it solve a real problem? Can it continue growing in the future? These questions create clarity. Clarity builds confidence. Benjamin Graham taught that investing is most intelligent when it is most businesslike. This means treating stocks like real ownership instead of quick trades. When you shift from speculation to ownership, your decisions become calmer and more thoughtful. Another important idea is that markets move faster than businesses. Stock prices can change every day, but real business progress happens slowly. This gap often creates confusion for beginners. Learning to focus on business progress instead of price movement is a major step forward. Not every company is a good investment. Some businesses struggle with competition, weak leadership, or declining demand. Understanding stocks means accepting that selection matters. Quality businesses tend to survive uncertainty better than weak ones. Over time, strong companies reinvest profits, innovate, and expand. Investors who remain patient benefit from this growth. This is why many successful investors hold investments for long periods. Charlie Munger often emphasized the power of owning a few great businesses rather than many average ones. He believed patience with quality creates exceptional outcomes. As a beginner, your goal is not perfection. Your goal is understanding. The more you learn about businesses, the less intimidating the market feels. Knowledge reduces fear. When you understand that stocks represent ownership, a new question naturally appears. If ownership is powerful, why do some people invest while others never start? Why do many people save money but avoid the market? The answer lies in beliefs, fears, and the way people think about risk and money. To move forward, you must understand why investing matters in the first place and what stops people from beginning. That is the focus of the next chapter. Chapter 2. Why investing matters. Earning money is important, but growing money is essential. Many people work hard for decades, yet struggle to build lasting wealth. The difference is often not income, it is investing. Saving keeps money safe for the short term. Investing allows money to grow over the long term. Without investing, inflation slowly reduces purchasing power. What feels like stability today may become limitation tomorrow. Investing matters because time rewards participation. Money that remains idle does not compound. Money that is invested has the opportunity to expand alongside economic growth. This quiet expansion is how wealth is built across generations. Warren Buffett built most of his wealth after many years of steady investing. His story teaches an important lesson. Consistency and patience often matter more than brilliance. Another reason investing matters is independence. Financial independence is not about luxury. It is about choice. The ability to choose meaningful work, spend time with family, and handle uncertainty with confidence. Investing creates options. Options reduce stress. Charlie Munger believed that the first 100,000 is difficult, but after that the process becomes easier because compounding begins to work. The early phase requires discipline more than skill. Many people avoid investing because they fear loss. Fear is natural. Markets move up and down, and uncertainty is unavoidable. But avoiding investing carries its own risk. The risk of falling behind rising costs and missed opportunity. Understanding this trade-off is crucial. Risk is not only losing money, risk is also failing to grow money. Another important point is that investing connects individuals to global progress. Businesses innovate, create technology, improve healthcare, and expand infrastructure. Investors participate in that progress. You are not just watching growth, you are part of it. Morgan Housel explains that wealth is what you do not see. It is the assets quietly growing in the background while life continues. Investing is the process that builds those invisible foundations. Investing also changes behavior. It encourages long-term thinking, delayed gratification, and continuous learning. These qualities improve not only financial outcomes, but decision-making in general life. However, investing does not require complexity. Many beginners believe they must understand everything before starting. This belief creates delay. In reality, progress begins with simple steps repeated consistently. John Bogle promoted the idea that ordinary investors can achieve extraordinary results by following simple strategies and staying disciplined. Simplicity reduces mistakes. Another reason investing matters is protection against uncertainty. Careers change. Economies shift. Unexpected events occur. Investments create a second engine of growth beyond earned income. Multiple sources of growth increase resilience. Over long periods, markets have rewarded patience despite short-term volatility. History shows cycles of optimism and fear, expansion and decline. Investors who remain committed through cycles benefit from recovery and growth. This does not mean the journey is easy. There will be moments of doubt, moments when doing nothing feels difficult, moments when noise is louder than logic. This is why mindset matters as much as strategy. As you begin to see why investing matters, another powerful idea emerges. If investing creates growth over time, what is the force that makes that growth accelerate? Why do small amounts invested early become large amounts later? The answer lies in one of the most important concepts in finance and life, the power of compounding. Understanding compounding transforms patience from effort into advantage. It explains why time is more valuable than timing, and why consistency beats intensity. To continue your journey, you must clearly understand how growth builds upon itself, and why waiting is not passive but productive. That is the focus of the next chapter. Chapter 3. The Power of Compounding. Compounding is the process where growth creates more growth. It is simple in idea, but powerful in effect. Money earns returns, and those returns begin earning their own returns. Over time, this creates acceleration that feels almost invisible at first and extraordinary later. Many beginners underestimate compounding because early progress looks small. The first phase requires patience. The visible rewards often appear much later. This delay causes people to quit before the real benefits arrive. Albert Einstein is often associated with the idea that compounding is one of the most powerful forces in the world. Whether spoken exactly or not, the message remains true. Time transforms small consistency into significant results. Compounding does not depend on large starting amounts. It depends on regular contribution and patience. Small investments repeated over years create meaningful wealth. This is why starting early matters more than starting big. Warren Buffett's wealth illustrates this clearly. His greatest advantage was not speed, but time. Decades of steady growth allowed compounding to work continuously. The lesson is not to copy his strategy exactly. The lesson is to respect time. Compounding also applies to knowledge. Every concept you learn improves future decisions. Better decisions improve outcomes. Improved outcomes build confidence. Confidence encourages consistency. This cycle creates intellectual compounding. Charlie Munger emphasized lifelong learning because knowledge compounds just like capital. Small improvements repeated consistently create an edge that grows over time. One challenge with compounding is emotional impatience. Humans prefer immediate rewards. We want visible progress quickly. But compounding rewards those who tolerate slow beginnings. Patience becomes a competitive advantage. Another important idea is that interruptions damage compounding. Frequent buying and selling, emotional reactions, and abandoning plans reset progress. Consistency allows compounding to continue uninterrupted. The fewer disruptions, the stronger the effect. Morgan Housel explains that long-term investing is less about intelligence and more about endurance. Endurance means staying invested during uncertainty and trusting the process. Compounding also changes the way you measure success. Daily price movements become less important than long-term direction. Short-term volatility becomes noise instead of threat. You begin focusing on years rather than days. There is also a hidden benefit. Compounding reduces pressure. You do not need extraordinary returns. Reasonable returns sustained for long periods are enough. This makes investing more realistic and less stressful. Another aspect of compounding is reinvestment. Allowing earnings to remain invested strengthens growth. Removing money too early slows the process. Reinvestment keeps momentum alive. Ray Dalio often speaks about cycles. Compounding works through cycles of expansion and decline. Temporary setbacks do not stop long-term growth if the process continues. Compounding is not only financial. Habits compound. Relationships compound. Skills compound. The same principle that grows wealth also grows character and capability. Understanding this makes patience easier because progress exists even when it is not immediately visible. Many investors fail not because their strategy is wrong, but because they stop too soon. They underestimate how powerful persistence becomes over time. The greatest returns often occur after long periods of steady effort. This realization changes behavior. Instead of searching for the next opportunity, you protect the process you already started. Protection of compounding becomes a priority. As you understand compounding, another question naturally arises. If time and growth are powerful, where does this growth actually take place? How does the system operate that allows millions of investors and businesses to interact every day? To continue, you must understand the environment where investing happens. You must understand the structure, movement, and purpose of the stock market itself. That is the focus of the next chapter. Chapter 4: How the Stock Market Works. The stock market is a system where ownership of businesses is exchanged. Buyers and sellers meet to trade shares of companies. This process happens continuously across the world. Prices change as expectations, information, and emotions change. At first, these movements can feel confusing. Numbers rise and fall quickly. News creates reactions. Opinions differ. But beneath this activity, one simple reality exists. The market reflects collective beliefs about business value. Companies list their shares on exchanges to raise capital. Investors provide money. Businesses use that money to grow operations, innovate, and expand. This relationship connects individual investors to economic progress. Short-term price movement often reflects sentiment rather than reality. Optimism pushes prices up. Fear pushes prices down. This emotional cycle repeats throughout history. Understanding this pattern reduces anxiety. Benjamin Graham explained that in the short run, the market behaves like a voting machine, but in the long run, it behaves like a weighing machine. This means popularity influences prices temporarily, while business performance determines long-term value. Another important concept is liquidity. Liquidity means the ability to buy or sell without significant difficulty. Stock markets provide liquidity, allowing investors to adjust positions when needed. This flexibility makes ownership accessible to ordinary individuals. However, liquidity also creates temptation. Because selling is easy, investors may react emotionally. Easy action can become unnecessary action. Successful investors learn when to act and when to remain still. Warren Buffett often highlights that the market exists to serve you, not instruct you. Prices offer opportunities rather than commands. This mindset prevents panic during declines and excitement during bubbles. Information plays a central role in market behavior. Earnings reports, economic data, innovation, leadership changes, and global events influence expectations. Markets process information rapidly, but interpretation varies. Different interpretations create price movement. This is why disagreement is essential. Every trade occurs because two people see value differently. One believes buying is wise, while another believes selling is wise. The market is a continuous conversation about value. Volatility is a natural feature of this conversation. Volatility does not mean the system is broken. It means uncertainty exists. Learning to accept volatility is a major step toward confidence. Ray Dalio emphasizes that markets move in cycles driven by human behavior and economic forces. Periods of growth are followed by periods of correction. Corrections are not failures. They are part of balance. Another key idea is efficiency. Markets attempt to reflect available information in prices. This does not mean prices are always correct. It means finding clear bargains requires patience and discipline. For beginners, the goal is not to outsmart the market immediately. The goal is to understand its nature. A dynamic system influenced by psychology, information, and business performance. Technology has made market participation easier than ever. Investors can research companies, monitor investments, and learn continuously. Access has increased, but access alone does not guarantee success. Understanding and behavior remain essential. The market rewards preparation more than prediction. Trying to forecast short-term movement often leads to frustration. Focusing on long-term ownership aligns your actions with how businesses actually grow. As you understand how the stock market works, another realization emerges. Knowledge alone does not create success. Two investors with the same information can achieve very different results. The difference often lies in mindset. How you think about risk, patience, and uncertainty shapes every decision you make. Before choosing investments, you must build the psychological foundation that supports good choices. That is the focus of the next chapter. Chapter 5. Building the right mindset. Investing success begins in the mind before it appears in the portfolio. Strategies matter, but behavior matters more. Two people can follow the same plan and achieve very different outcomes because their reactions differ. Mindset shapes decisions, and decisions shape results. The market constantly tests emotions. Prices rise and create excitement. Prices fall and create fear. Noise encourages action even when patience is the better choice. Without the right mindset, knowledge becomes fragile. Morgan Housel explains that doing well with money is less about intelligence and more about behavior. This insight shifts focus from predicting the future to managing yourself. Self-management is the real skill behind long-term success. A strong investing mindset begins with humility. No one can predict markets consistently. Accepting uncertainty reduces pressure and prevents overconfidence. Humility encourages preparation instead of prediction. Another important quality is patience. Markets reward those who allow time to work. Impatience leads to frequent changes, and frequent changes interrupt compounding. Patience is not passive. It is disciplined waiting. Warren Buffett often speaks about temperament. He believes successful investors control emotions better than they control information. This means staying calm when others panic and remaining rational when others become overly optimistic. The right mindset also includes long-term thinking. Short-term movement is unpredictable. Long-term business progress is more understandable. Shifting attention from days to years reduces stress and improves clarity. Fear is one of the strongest forces in investing. Fear of loss, fear of missing opportunities, and fear of uncertainty influence decisions. Recognizing fear does not remove it, but awareness prevents automatic reactions. Awareness creates space for thoughtful action. Greed is equally powerful. Rapid gains create the desire for more. This desire often leads to excessive risk. Balancing ambition with discipline protects progress. Charlie Munger emphasized rationality as a core principle. Rational investors avoid extremes. They question assumptions, seek evidence, and remain open to changing their views. Rationality supports consistency. Another essential mindset shift is accepting volatility as normal. Market declines are not interruptions. They are features of the system. Viewing volatility as opportunity instead of threat transforms experience. Confidence grows when expectations align with reality. Developing the right mindset also means focusing on process rather than outcomes. Short-term outcomes can be random. A good decision may lead to a temporary loss. A poor decision may lead to a temporary gain. Evaluating decisions based on process builds long-term discipline. James Clear teaches that identity drives behavior. When you see yourself as a long-term investor, your actions naturally align with patience and consistency. Identity creates stability during uncertainty. Comparison is another challenge. Seeing others succeed quickly can create frustration. Every investing journey is different. Comparing timelines creates pressure that leads to poor decisions. Progress measured against your own goals is more meaningful. The right mindset includes continuous learning. Markets evolve, businesses change, and new ideas emerge. Curiosity keeps investors adaptable. Adaptability reduces rigidity and improves resilience. There is also value in simplicity. Complex thinking can create overconfidence. Simple principles repeated consistently often produce better results than complicated strategies applied inconsistently. Simplicity supports clarity. Ray Dalio speaks about radical open-mindedness. This means accepting that your understanding is always incomplete. Seeking different perspectives strengthens decision-making. Open-minded investors learn faster. Mindset also influences reaction to mistakes. Mistakes are inevitable. Viewing mistakes as feedback instead of failure accelerates growth. Reflection transforms experience into knowledge. Another powerful idea is delayed gratification. Choosing long-term benefit over immediate reward strengthens discipline. Delayed gratification is the foundation of compounding because it allows growth to continue uninterrupted. As mindset improves, investing becomes less stressful. You begin to see volatility as normal, patience as productive, and learning as continuous. Confidence replaces urgency. Clarity replaces noise. However, mindset alone is not enough. You must translate mindset into action through the types of investments you choose. Beginners often feel overwhelmed by options. Thousands of stocks, different strategies, and conflicting advice create confusion. To move forward, you need simplicity. You need to understand how to choose investments that align with long-term thinking and reduce unnecessary complexity. That is the focus of the next chapter. Chapter 6. Choosing simple investments. Investing becomes difficult when choices become complicated. Thousands of options can create hesitation. Complex strategies promise higher returns, but often increase confusion and mistakes. Simplicity provides clarity and consistency. Simple investments are easier to understand, easier to maintain, and easier to hold during uncertainty. The goal is not sophistication. The goal is effectiveness. John Bogle believed that simplicity is one of the greatest advantages an investor can have. One approach to simplicity is diversification. Diversification means spreading investments across different businesses and sectors. This reduces dependence on a single outcome. When one investment struggles, others may support stability. Index investing is often considered a simple strategy. Instead of selecting individual companies, investors participate in a broad group of businesses. This approach captures overall market growth and reduces the pressure of constant selection. Many studies suggest that broad market exposure combined with patience produces strong long-term results. Another simple approach is focusing on high-quality businesses. Strong companies usually have durable demand, capable leadership, and consistent earnings. Quality does not guarantee success, but it improves the probability of resilience. Charlie Munger emphasized owning great businesses and allowing time to work. Beginners sometimes believe more investments mean better results. In reality, excessive diversification can create complexity without additional benefit. Balance is important. Enough diversification to reduce risk, but enough focus to maintain clarity. Simple investing also involves clear criteria. Understanding how a business makes money, whether it has competitive advantages, and whether it can grow over time creates structure. Structure reduces emotional decisions. Warren Buffett often highlights the importance of staying within your circle of competence. This means investing in businesses you can understand. Clarity builds conviction. Conviction supports patience. Costs are another factor that influences simplicity. Frequent trading, complex products, and high fees reduce long-term returns. Keeping costs low allows compounding to work more effectively. Small expenses repeated over time create meaningful impact. Consistency strengthens simple strategies. Regular investing removes the need to predict market timing. Instead of waiting for perfect moments, investors participate steadily. Participation over prediction reduces stress. Another advantage of simplicity is emotional stability. Complicated strategies often require constant monitoring. Constant monitoring increases anxiety. Simple approaches allow investors to focus on long-term progress rather than daily movement. Morgan Housel explains that reasonable expectations are essential. Simple investing does not promise extraordinary short-term gains. It aims for sustainable growth over long periods. Sustainable growth is more reliable than rapid fluctuation. Technology has increased access to complex financial products. Access does not mean necessity. Many advanced strategies are designed for professionals with specific goals and resources. Ordinary investors often achieve better results with straightforward methods. Simplicity also encourages discipline during volatility. When your approach is clear, uncertainty becomes easier to navigate. You are less likely to abandon your plan because the plan is understandable. Ray Dalio speaks about balancing risk and return. Simple, diversified portfolios often provide this balance effectively. The objective is not maximizing every opportunity, but creating steady progress. Another important idea is alignment with personal goals. Simple investments should reflect your timeline, risk tolerance, and financial objectives. There is no universal portfolio that suits everyone. Personal clarity improves decision quality. Learning continues even with simple strategies. Simplicity does not mean ignorance. It means focusing on principles that matter instead of chasing every new idea. Focused learning compounds faster than scattered attention. Over time, investors realize that complexity often hides uncertainty rather than reducing it. Simple frameworks reveal reality more clearly. Clarity supports confidence. As you begin choosing simple investments, another important consideration emerges. Every investment involves uncertainty. Understanding how to manage that uncertainty is essential for long-term survival. Risk is unavoidable, but unmanaged risk can interrupt progress. Learning how to balance opportunity and protection allows growth to continue even during difficult periods. That is the focus of the next chapter. Chapter 7. Risk and Diversification. Risk is a natural part of investing. It cannot be removed, but it can be understood and managed. Many beginners see risk only as the possibility of losing money. In reality, risk also includes uncertainty, volatility, and the chance of missing long-term growth. Understanding risk changes behavior. Instead of avoiding investing completely, you learn how to participate carefully. Careful participation allows progress without unnecessary exposure. Diversification is one of the most effective ways to manage risk. Diversification means spreading investments across different companies, industries, and sometimes different regions. This approach prevents a single negative outcome from damaging the entire portfolio. Protection supports consistency. Ray Dalio described diversification as the closest thing to a free advantage in investing. When assets respond differently to events, overall volatility decreases. Lower volatility makes it easier to stay invested during uncertainty. Risk also relates to concentration. Owning too few investments increases dependence on specific outcomes. Owning too many without understanding them creates confusion. Balance is essential. Thoughtful diversification combines clarity with protection. Another dimension of risk is time horizon. Short-term investing carries higher uncertainty because price movement is unpredictable. Long-term investing allows business performance to influence results. Time reduces the impact of temporary fluctuations. Warren Buffett often emphasizes that risk comes from not knowing what you are doing. Knowledge reduces avoidable risk. Learning about businesses, strategies, and personal goals strengthens decision-making. Emotional risk is equally important. Fear can lead to selling during declines. Excitement can lead to excessive risk during rising markets. Emotional reactions amplify financial risk. Creating rules helps reduce this effect. Margin of safety is another important idea. Benjamin Graham introduced the concept of allowing room for error. Investing with reasonable expectations and avoiding extreme assumptions provides protection. Preparation for uncertainty increases resilience. Liquidity risk should also be considered. Some investments are difficult to sell quickly without affecting price. Maintaining a portion of easily accessible assets provides flexibility. Flexibility reduces pressure during unexpected situations. Diversification does not eliminate losses. It reduces the probability of catastrophic outcomes. The goal is survival first and growth second. Investors who survive uncertainty allow compounding to continue. Another important aspect of risk management is position size. No single investment should determine your financial future. Limiting exposure to individual ideas protects against unexpected events. This discipline supports long-term stability. Morgan Housel explains that the most important investing skill is staying in the game. Avoiding irreversible mistakes matters more than achieving perfect decisions. Risk management is the foundation of staying in the game. Understanding correlation also improves diversification. Some investments move together because they respond to similar factors. True diversification involves combining assets that behave differently under various conditions. This balance stabilizes outcomes. Risk perception changes with experience. Beginners often fear volatility more than permanent loss. Over time, investors learn that temporary declines are normal, while poor decisions create lasting damage. Clarity shifts attention toward meaningful risk. Another layer of risk is leverage. Borrowing to invest increases potential gains, but also magnifies losses. Leverage reduces margin for error. Many experienced investors use caution when dealing with borrowed money. Diversification extends beyond investments. Income sources, skills, and financial habits contribute to overall stability. A strong financial foundation supports better investing decisions. Stability outside the portfolio reduces pressure inside the portfolio. Risk management is not about eliminating opportunity. It is about creating conditions where opportunity can be pursued safely. This mindset encourages steady participation rather than extreme behavior. As you understand risk and diversification, you begin to see how many investing mistakes originate not from lack of knowledge, but from predictable human behavior. Chasing trends, reacting to headlines, and abandoning plans during uncertainty are common patterns. Learning to recognize and avoid these mistakes protects progress more than discovering new strategies. Prevention is often more powerful than correction. That is the focus of the next chapter. Chapter 8. Avoiding common mistakes. Mistakes are a natural part of investing. Every investor experiences them. The goal is not perfection, but awareness. Awareness reduces repetition, and reduced repetition protects long-term progress. One of the most common mistakes is chasing trends. When prices rise quickly, excitement attracts attention. Many investors enter after most of the growth has already occurred. This behavior is driven by fear of missing out, rather than thoughtful analysis. Warren Buffett warned that popularity should not guide investment decisions. What feels comfortable in the moment is not always wise in the long run. Independent thinking creates stability. Another frequent mistake is reacting to short-term news. Financial headlines are designed to capture attention, not support patience. Constant information creates urgency even when no action is required. Successful investors learn to filter noise. Frequent trading is another challenge. Buying and selling repeatedly increases costs and interrupts compounding. Activity feels productive, but excessive activity often reduces returns. Charlie Munger emphasized that patience is a competitive advantage because few people practice it. Timing the market is a mistake many beginners attempt. Predicting exact highs and lows is extremely difficult. Waiting for perfect moments often leads to missed opportunities. Participation over time is usually more effective than prediction. Emotional decision-making creates additional risk. Fear encourages selling during declines. Excitement encourages buying during peaks. These reactions reverse the logic of long-term investing. Creating predefined rules helps prevent impulsive behavior. Another mistake is lack of diversification. Concentrating too heavily in a single idea increases vulnerability. Unexpected events can affect any business. Diversification provides protection against uncertainty. Ignoring costs is also common. Fees, taxes, and unnecessary complexity reduce long-term growth. Small expenses repeated over many years create significant impact. Efficiency supports compounding. Overconfidence can damage progress. Early success may create the illusion of skill. This illusion encourages larger risks without proper preparation. Humility protects investors from excessive exposure. Benjamin Graham advised investors to view themselves as their own worst enemy. Recognizing personal biases reduces avoidable mistakes. Self-awareness is a powerful form of risk management. Another mistake is abandoning a plan during volatility. Market declines are uncomfortable, but they are normal. Changing strategies based on temporary movement interrupts long-term progress. Consistency is often more valuable than adjustment. Comparison also creates difficulty. Observing others achieving rapid gains can create frustration. Different goals, timelines, and risk tolerance make comparisons misleading. Personal progress is more meaningful than relative performance. Neglecting research is another challenge. Investing without understanding increases uncertainty. Even simple strategies require basic awareness. Learning builds confidence and reduces reactive behavior. Impatience is one of the most costly mistakes. Compounding requires time, but many investors expect immediate results. Short-term expectations lead to unnecessary changes. Realistic expectations support persistence. Another subtle mistake is complexity for its own sake. Complex strategies can create the impression of sophistication while increasing confusion. Simplicity often produces more consistent outcomes. Clarity improves decision-making. Ray Dalio highlights the importance of reflection after mistakes. Reviewing decisions without judgment transforms experience into knowledge. Reflection prevents repetition and strengthens future behavior. There is also the mistake of ignoring personal circumstances. Investment choices should align with financial goals, time horizon, and emotional tolerance. Strategies that work for others may not suit your situation. Alignment improves sustainability. Avoiding mistakes does not mean avoiding all risk. It means reducing avoidable errors so necessary risk can be taken thoughtfully. Progress becomes smoother when major disruptions are minimized. Over time, investors realize that success is often the result of doing fewer wrong things rather than discovering extraordinary ideas. Protection of capital and consistency of behavior create strong foundations. As mistakes become clearer, another important step emerges. Awareness alone is not enough. You need a structure that supports good behavior automatically. A system transforms intention into action. A consistent system removes guesswork, reduces emotional influence, and ensures steady participation. Systems allow discipline to continue even when motivation fluctuates. That is the focus of the next chapter. Chapter 9. Creating a consistent system. A system turns good intentions into consistent action. Without a system, investing depends on mood, news, and short-term emotions. With a system, decisions follow structure rather than impulse. Structure supports discipline. A consistent system begins with clear goals. Goals define direction and time horizon. Short-term needs require stability. Long-term goals allow growth and volatility. Clarity about purpose guides every decision that follows. Another important element is regular investing. Investing consistently removes the pressure of timing the market. Instead of waiting for perfect conditions, you participate steadily. Participation allows compounding to continue without interruption. Automation can strengthen consistency. When contributions happen automatically, behavior becomes less dependent on motivation. Good habits become default actions. James Clear explains that environment shapes behavior. Automation creates an environment that supports discipline. A system also includes allocation. Allocation means deciding how investments are distributed across different assets. This distribution should reflect risk tolerance, time horizon, and personal comfort. Balanced allocation reduces emotional stress during volatility. Rebalancing is another part of a system. Over time, some investments grow faster than others. Rebalancing restores the original allocation and prevents unintended concentration. This process maintains alignment with goals. Rules help reduce emotional decisions. Rules may include guidelines for adding investments, reviewing performance, and responding to major changes. Clear rules prevent impulsive reactions during uncertainty. Consistency replaces guesswork. Warren Buffett emphasizes that a good process produces good outcomes over time. Focusing on process rather than short-term results builds confidence. Confidence supports persistence. A system should also define review frequency. Constant monitoring increases anxiety. Periodic review provides awareness without emotional overload. Balance between awareness and detachment improves decision quality. Documentation strengthens a system. Writing down reasons for investments creates accountability. Later reflection reveals whether decisions were thoughtful or emotional. Learning accelerates when decisions are recorded. Flexibility is important within structure. A system should allow adaptation when new information emerges. Rigid thinking ignores reality. Flexible structure maintains direction while allowing improvement. Another essential component is risk management. Position size, diversification, and liquidity should be integrated into the system. Protection is not separate from growth. Protection enables growth to continue. Morgan Housel highlights that consistency is more important than intensity. A simple plan followed for many years often outperforms complex plans followed briefly. Longevity strengthens results. A consistent system reduces decision fatigue. Instead of evaluating every market movement, you follow predefined steps. Mental energy is preserved for meaningful analysis rather than constant reaction. Accountability improves adherence. Sharing goals with a trusted partner or maintaining a personal journal increases commitment. External awareness reinforces internal discipline. Another part of a strong system is expectation management. Markets will not move smoothly. Periods of stagnation and decline are normal. Expecting variability prevents disappointment. Ray Dalio speaks about designing systems that work across different environments. A resilient system anticipates uncertainty rather than assuming stability. Preparation reduces stress when conditions change. Technology can support systems, but should not replace thinking. Tools help track progress and automate actions, but principles guide decisions. Technology is an assistant, not a substitute for judgment. A system also includes learning routines. Regular reading, reflection, and evaluation ensure continuous improvement. Learning compounds just like capital. Curiosity strengthens adaptability. Over time, a consistent system creates identity. You no longer see investing as occasional activity. You see it as a structured process integrated into daily life. Identity supports persistence during uncertainty. There will be moments when the system feels slow. Slow progress can create doubt, but systems are designed for long horizons. Trusting the process allows compounding to unfold. As your system becomes stable, another important shift occurs. You begin thinking less about individual decisions and more about time horizon. Perspective expands beyond immediate outcomes. Long-term thinking transforms investing from a series of reactions into a continuous journey. Understanding the value of patience allows your system to operate fully. That is the focus of the next chapter. Chapter 10. Thinking long-term. Long-term thinking is one of the most powerful advantages an investor can develop. While many people focus on immediate results, long-term investors focus on direction. Direction matters more than short-term movement. Markets change daily, sometimes dramatically. These changes create the illusion that constant action is necessary. In reality, business growth unfolds slowly. Aligning your perspective with this pace improves decision quality. Jeff Bezos once explained that long-term thinking reduces competition because fewer people are willing to wait. Waiting is uncomfortable, but it creates opportunity. Patience allows compounding to operate without interruption. Short-term thinking often magnifies noise. News cycles, price fluctuations, and market sentiment dominate attention. Long-term thinking filters this noise and highlights fundamentals. Fundamentals determine lasting value. Warren Buffett's approach demonstrates this principle clearly. He evaluates businesses based on their ability to generate value over many years. Temporary volatility does not change long-term potential unless the business itself changes. This distinction is essential. Long-term thinking also reduces emotional pressure. When your horizon extends beyond immediate movement, temporary declines become less threatening. Perspective creates stability. Another benefit is better decision-making. Choices guided by long-term goals tend to prioritize quality, sustainability, and discipline. Short-term choices often prioritize speed and excitement. Different time horizons produce different behavior. Morgan Housel explains that wealth building is less about brilliance and more about consistency sustained for long periods. Consistency requires patience. Patience requires belief in the future. Long-term investors accept uncertainty as part of the process. They understand that predictions will be imperfect and outcomes will vary. Acceptance reduces frustration. Reduced frustration supports persistence. Compounding becomes visible only when time is allowed to pass. Interruptions reset progress. Staying invested during uncertainty preserves momentum. Momentum transforms small efforts into meaningful results. Another important idea is that long-term thinking encourages learning from cycles. Markets move through optimism, pessimism, expansion, and contraction. Viewing these cycles from a distance reveals patterns that are invisible in short time frames. Understanding patterns improves resilience. Charlie Munger emphasized the importance of sitting quietly with good investments. Activity is not always productive. Sometimes the best decision is patience. This mindset contrasts with the desire for constant engagement. Long-term thinking also influences expectations. Realistic expectations reduce disappointment. Investors who expect smooth progress often struggle during volatility. Those who expect variability remain prepared. There is also a psychological advantage. Extending your horizon reduces the importance of comparison. Short-term performance differences lose significance when measured over many years. Personal progress becomes the primary focus. Long-term thinking supports risk management. Decisions are evaluated based on durability rather than immediate reward. Durability protects against unpredictable events. Sustainable growth becomes the objective. Ray Dalio highlights that understanding cycles requires perspective beyond immediate experience. Looking at history provides context. Context prevents overreaction. Another dimension of long-term thinking is alignment with life goals. Investments should support future choices such as freedom, security, and opportunity. When investing connects to meaningful goals, patience becomes easier. Technology and constant information can challenge long-term thinking. Instant updates create the illusion that action is required. Developing the ability to ignore irrelevant information becomes a valuable skill. Attention is a limited resource. Long-term investors protect attention carefully. They choose learning over noise and process over excitement. This focus strengthens discipline. Over time, long-term thinking becomes identity rather than strategy. You begin to evaluate decisions based on years instead of days. This shift reduces stress and improves consistency. However, even with long-term perspective, emotions remain influential. Fear, excitement, doubt, and optimism continue to appear. Understanding how emotions affect decisions becomes essential for maintaining discipline. Emotional awareness allows long-term thinking to translate into consistent behavior. Without emotional control, perspective alone may not prevent impulsive decisions. That is the focus of the next chapter. Chapter 11. The role of emotions. Emotions are always present in investing. Even the most experienced investors feel fear, excitement, doubt, and hope. The difference is not the absence of emotion, but the ability to manage it. Emotional awareness protects long-term decisions. Fear is one of the strongest emotional forces. Market declines trigger the instinct to protect. Selling feels safe in the moment, but fear-driven decisions often interrupt compounding. Understanding that volatility is normal reduces the power of fear. Excitement creates the opposite problem. Rapid gains encourage optimism and risk-taking. Investors may ignore warning signs because success feels continuous. Balancing optimism with discipline prevents excessive exposure. Daniel Kahneman showed that humans experience losses more intensely than gains. This tendency influences behavior. The desire to avoid loss can lead to premature selling or avoidance of opportunity. Recognizing this bias helps create rational responses. Another emotional influence is regret. Missing opportunities can create pressure to act quickly on the next idea. This reaction often leads to poor timing. Accepting that no investor captures every opportunity reduces regret-driven decisions. Patience is closely connected to emotional stability. Waiting requires tolerance for uncertainty. Tolerance improves when expectations are realistic. Realistic expectations create calm behavior. Warren Buffett emphasizes temperament over intelligence. He believes successful investing depends on maintaining rational thinking during emotional periods. Rationality provides consistency. Social influence also affects emotions. Seeing others succeed rapidly can create pressure to change strategies. Comparison increases anxiety and reduces confidence in your own plan. Focusing on personal goals protects emotional stability. Media exposure amplifies emotional swings. Constant updates highlight extremes rather than averages. Limiting unnecessary information helps maintain perspective. Attention management is emotional management. Another emotional challenge is attachment to investments. Investors may identify with certain ideas and resist reconsideration. Detachment allows objective evaluation. Flexibility improves decision quality. Charlie Munger encouraged inversion as a thinking tool. Instead of asking how to succeed, ask what could cause failure. This perspective reduces emotional bias and strengthens preparation. Emotions also influence risk perception. During optimistic periods, risk appears smaller. During pessimistic periods, risk appears larger. Awareness of this distortion prevents extreme behavior. Creating rules reduces emotional influence. Rules provide guidance when feelings are intense. Predefined actions support consistency. Structure protects rational thinking. Morgan Housel explains that staying calm during uncertainty is one of the rarest skills in finance. Calm behavior allows investors to benefit from opportunities that others avoid due to fear. Emotional control becomes advantage. Reflection strengthens emotional awareness. After each decision, consider whether emotion influenced the choice. Honest evaluation builds self-understanding. Self-understanding improves future behavior. Another important idea is acceptance of uncertainty. Markets cannot be controlled. Outcomes cannot be guaranteed. Accepting uncertainty reduces the desire for constant reassurance. Confidence emerges from process rather than prediction. Emotional resilience develops gradually. Experience with cycles, mistakes, and recovery builds perspective. Perspective reduces intensity of future emotional reactions. Learning transforms discomfort into strength. Support systems can also help. Discussing decisions with trusted individuals introduces different perspectives. External feedback reduces emotional isolation. Shared learning strengthens discipline. Over time, emotional awareness allows long-term thinking to remain intact during volatility. You begin to respond instead of react. This shift creates stability in behavior and outcomes. As emotional control improves, attention naturally moves toward evaluating progress. Investors often focus on daily movement rather than meaningful indicators. Understanding how to measure progress correctly prevents unnecessary stress. Progress in investing is not defined by short-term fluctuations. It is defined by consistency, learning, and alignment with goals. Knowing what to measure clarifies direction. That is the focus of the next chapter. Chapter 12. Measuring progress. Progress in investing is often misunderstood. Many investors look at daily price movement and assume it reflects success or failure. Short-term movement is rarely meaningful. Real progress is gradual, quiet, and visible only over time. Measuring progress begins with clarity about goals. If your objective is long-term growth, short-term volatility should not define success. When goals and measurement align, decision-making becomes calmer. Clarity reduces unnecessary concern. One important measure of progress is consistency. Regular investing demonstrates discipline regardless of market conditions. Consistency allows compounding to operate continuously. Process-driven behavior creates predictable improvement. Another meaningful indicator is portfolio allocation. Maintaining alignment with risk tolerance and time horizon shows that decisions remain intentional. Drift without awareness can increase risk unintentionally. Periodic review preserves balance. Learning is also a form of progress. Each concept understood improves future choices. Better choices strengthen outcomes. Knowledge compounds just like capital. Warren Buffett often highlights that understanding businesses is more important than reacting to prices. When knowledge grows, confidence grows. Confidence supports patience. Behavioral improvement is another important measure. If emotional reactions decrease and discipline increases, progress is occurring even if short-term returns fluctuate. Behavior shapes long-term results. Morgan Housel explains that wealth building involves invisible progress. Assets grow quietly while daily life continues. This invisibility can create doubt. Recognizing hidden growth maintains motivation. Tracking long-term trends rather than short-term changes provides perspective. Looking at broader timeframes reveals direction that daily movement hides. Perspective reduces emotional intensity. Another useful measure is cost efficiency. Lower fees, reduced unnecessary trading, and simple structures support growth. Small efficiencies compound into meaningful advantages. Reflection is an essential part of measuring progress. Reviewing past decisions reveals patterns. Patterns highlight strengths and weaknesses. Awareness enables improvement. Documentation supports reflection. Recording reasons for investments allows comparison between expectation and outcome. Learning becomes structured rather than accidental. Structure accelerates development. Risk management is also part of progress. Maintaining diversification, Avoiding excessive concentration and preserving liquidity demonstrate discipline. Protection ensures sustainability. Comparisons can distort perception of progress. Different investors have different circumstances. Comparing outcomes without context creates frustration. Personal benchmarks are more meaningful than external ones. Another indicator of progress is emotional stability. If volatility produces less anxiety than before, resilience is increasing. Resilience supports long-term participation. Ray Dalio emphasizes that improvement requires feedback loops. Decisions create outcomes. Outcomes create lessons. Lessons inform future decisions. This continuous cycle produces growth. It is also important to celebrate small achievements. Consistency over months and years represents significant effort. Acknowledging progress reinforces positive habits. Recognition sustains motivation. Patience is central to measuring progress. Some periods will show little visible change. These periods are not failure. They are part of compounding. Another meaningful measure is alignment with life goals. If investing supports security, flexibility, and opportunity, progress is occurring even if returns vary. Financial growth should enhance life quality. Technology can help track metrics, but numbers alone do not tell the full story. Context and behavior provide meaning. Balanced evaluation prevents overreaction. Over time, investors learn that progress is rarely dramatic. It is steady improvement supported by discipline, learning, and patience. Understanding this reduces the desire for constant validation. As you learn to measure progress correctly, another challenge becomes clearer. Periods of uncertainty and stagnation will still occur. Maintaining discipline during these periods requires commitment. Commitment allows systems and compounding to continue. Staying the course is not passive. It is an active decision to trust process despite temporary discomfort. This decision separates long-term investors from short-term participants. That is the focus of the next chapter. Chapter 13. Staying the course. Every investing journey includes uncertainty. Markets rise, decline, recover, and evolve. These changes test patience more than knowledge. Staying the course means continuing the process despite temporary discomfort. Many investors begin with strong intentions. They create plans, learn principles, and invest consistently. The challenge appears when volatility increases. Doubt replaces confidence. The desire to act becomes strong, even when no action is necessary. Staying the course requires trust in long-term thinking. Trust does not mean ignoring reality. It means distinguishing between temporary movement and meaningful change. This distinction protects progress. Jack Bogle repeatedly encouraged investors to stay the course. His message was simple. Markets fluctuate, but disciplined participation over time creates growth. Consistency is more powerful than prediction. One reason staying the course is difficult is emotional pressure. Declines feel permanent in the moment. Recovery feels uncertain. History shows that markets move through cycles, yet emotions focus on the present. Perspective reduces intensity. Another challenge is external noise. Opinions, forecasts, and headlines create conflicting messages. Constant information can weaken conviction. Limiting unnecessary input supports clarity. Warren Buffett emphasized that successful investing often involves inactivity. Not acting during volatility can be more difficult than acting. Patience becomes a deliberate choice. Preparation makes staying the course easier. When expectations include volatility, declines feel normal rather than surprising. Prepared investors experience uncertainty differently than unprepared investors. Expectation shapes reaction. Diversification supports commitment. Balanced portfolios reduce the impact of individual setbacks. Reduced volatility makes patience more sustainable. Structure protects discipline. Another important factor is time horizon. Short horizons magnify temporary movement. Long horizons absorb fluctuations. Extending perspective reduces urgency. Morgan Housel explains that endurance is a defining characteristic of successful investors. Endurance means remaining committed through periods that feel uncomfortable. Comfort is not required for progress. Staying the course does not mean ignoring mistakes. If fundamental conditions change, reassessment is appropriate. The difference lies in responding to evidence rather than emotion. Rational adjustment differs from reactive change. Support systems can strengthen commitment. Discussing decisions with trusted individuals provides perspective. Shared learning reduces isolation during uncertainty. Community supports resilience. Routine also helps. Regular review schedules maintain awareness without constant monitoring. Structured routines prevent impulsive behavior. Consistency becomes habit. Another helpful idea is focusing on process rather than outcomes. Short-term outcomes can be random. A sound process repeated consistently increases the probability of favorable results. Process-driven thinking reduces frustration. Charlie Munger often highlighted the importance of avoiding unnecessary change. Constant adjustment creates instability. Stability allows compounding to operate uninterrupted. Reflection reinforces commitment. Reviewing past recoveries builds confidence in future resilience. Experience transforms uncertainty into familiarity. Familiarity reduces fear. There will be moments when progress appears slow. Slow periods test patience more than declines. Recognizing that compounding includes quiet phases prevents discouragement. Silence does not mean stagnation. Staying the course also involves maintaining personal financial stability. Emergency reserves and balanced obligations reduce pressure to act prematurely. Stability outside investments supports stability within investments. Over time, commitment becomes identity. You no longer decide whether to stay the course. Staying the course becomes the default behavior. Identity strengthens discipline. As commitment deepens, attention naturally shifts toward action beyond theory. Understanding principles is valuable, but implementation creates results. Beginning is often the most important step. The final stage of this journey focuses on translating knowledge, mindset, and systems into practical action. Starting with clarity allows long-term growth to begin. That is the focus of the next chapter. Chapter 14, Your First Steps Forward. Every investing journey eventually reaches a simple moment. The moment of beginning. Learning creates readiness, but action creates progress. Starting does not require perfection. It requires willingness. Your first step is clarity. Understand why you want to invest. Financial security, independence, flexibility, or future opportunities may guide your purpose. Clear purpose strengthens commitment during uncertainty. The next step is preparation. Create a basic financial foundation before investing aggressively. Emergency reserves provide stability. Stability allows patience when markets fluctuate. Begin with amounts that feel comfortable. Small beginnings reduce emotional pressure. Confidence grows through experience. Experience transforms theory into understanding. Warren Buffett often emphasized that simple actions repeated over long periods produce powerful outcomes. You do not need complex strategies to begin. You need consistency. Choose investments that align with your knowledge and goals. Simplicity supports discipline. Avoid the temptation to follow every new idea. Focus strengthens clarity. Create a routine. Regular investing removes the burden of decision-making each time. Routine transforms investing into habit. Habits create stability. Documentation helps in early stages. Write down your reasons, expectations, and goals. This record becomes a reference during uncertainty. Reflection improves future decisions. Learning should continue alongside action. Markets evolve, businesses change, and your understanding deepens. Curiosity keeps progress active. Active learning compounds over time. Patience remains essential even after beginning. Early progress may appear slow. Slow progress does not mean failure. Compounding requires time to become visible. Morgan Housel explains that successful investors accept that the journey includes uncertainty and variability. Acceptance reduces frustration. Reduced frustration supports persistence. Avoid comparing your beginning with someone else's middle. Every journey follows a different timeline. Personal progress is the only meaningful measure. Another important step is managing expectations. There will be periods of growth and periods of stagnation. Expecting variability prevents emotional reactions. Realistic expectations create resilience. Risk awareness should remain present. Diversification, position size, and liquidity protect early progress. Protection allows confidence to grow gradually. Technology can support your first steps. Tools help track contributions, allocation, and performance. Use technology for clarity, not constant monitoring. Balance improves experience. Celebrate small milestones. Consistency over months and years represents meaningful achievement. Recognition reinforces positive behavior. Positive behavior compounds. Charlie Munger believed that knowing a few important principles deeply is more valuable than knowing many ideas superficially. Focus on fundamentals. Depth creates conviction. Over time, your first steps become routine. Routine becomes identity. Identity supports long-term discipline without constant effort. The most important realization is that investing is not a single decision. It is a lifelong process of learning, adapting, and remaining consistent. Beginning opens the door to compounding. You now understand the principles, mindset, risks, and behaviors that support investing success. The final stage is reflection on what this journey represents beyond financial growth. That is the focus of the conclusion. Conclusion: the investor you are becoming. Stock investing is not only about returns, it is about perspective, discipline, and long-term thinking. The journey shapes how you view time, uncertainty, and opportunity. Wealth is built quietly through consistent actions repeated over years. Patience becomes strength. Learning becomes habit. Discipline becomes identity. The market will continue to change. Opportunities will appear and disappear. Your greatest advantage will remain behavior. Warren Buffett once said that the stock market is a device for transferring money from the impatient to the patient. This idea captures the essence of investing. Patience allows compounding to work fully. The investor you are becoming matters more than any single investment. Clarity guides decisions. Consistency sustains progress. Resilience supports recovery. Begin with humility. Continue with discipline. Trust time. Allow growth to unfold. Your journey has already started.